If you look at the headline numbers in the 2083 budget, you might assume the government just handed everyone a massive raise. The personal income tax exemption limit has been doubled to a full 10 lakh rupees. The relief continues. The maximum marginal rate for personal income tax dropped by 10%. And for those trading listed stocks, capital gains tax is now considered final. On paper, it looks like a significant win for your paycheck. But then we hit the mathematical reality. Running a country requires capital. If we check the official annexes, the government still needs to generate a staggering 14,042 billion rupees in total revenue this fiscal year. This chart shows the core problem. You have a towering revenue target on one side, but the primary source of income, direct taxes from your paycheck, is shrinking. That creates a massive gap between what the state earns and what it absolutely has to spend. To fill that gap, policymakers aren't taking less of your money. They are simply changing exactly when and exactly how they extract it. The 2083 budget swaps the single macro tax on your paycheck for a web of micro taxes. Instead of taking one large percentage of your income, the state now collects tiny, recurring slivers from almost everything you do. Before launching new fees, the government first optimized the massive indirect tax nets already in place, and they started at the borders. They took 11 complex tiers of customs duties and collapsed them down to 7 categories. The goal is to lower the cost of importing raw materials to encourage actual domestic manufacturing. Next, they overhauled the value-added tax, or VAT, with a specific incentive. If you pay for goods using a digital platform, you instantly get a 10% rebate on the VAT. This rebate functions as an enforcement tool. By incentivizing digital billing, the government effectively outsources tax monitoring to you, the consumer, forcing cash-only vendors into a trackable system. By smoothing out customs at the border and digitizing VAT at the register, the state secures a reliable baseline of consumption revenue. With that foundation set, they can unleash the micro-taxes. This is where the budget gets highly specific. We are looking at fees placed on almost every modern convenience in your routine. Take your digital life. The state levies a 2% digital service tax on foreign tech giants. It trickles down to devices too. Installing a telephone incurs a 500 rupee charge, and using mobile or internet networks carries a 10% telecommunication fee. Then we move from digital life to social services through a new category called equity fees. These fees target private institutions. Private schools and private hospitals are now required to pay a percentage of their revenue as an equity fee, which the government earmarks to fund public infrastructure. Whether scrolling a social feed, sending a child to private school, or booking a clinic appointment, the government has attached a mandatory micro percentage to the action. This granular taxation extends to anyone trying to build a life or pursue education outside of Nepal's borders. If you secure foreign employment, the agencies managing that process are required to collect a 1% service fee from the amount you pay them. If you are a student heading abroad, exchanging your currency to pay for foreign tuition triggers a 3% education service fee on the exchanged amount. Back home, environmental impact is monetized too. Every single liter of petrol or diesel sold inside the country carries a 1 rupee and 50 peso pollution control charge. They've also implemented a green tax at customs points, alongside a clean infrastructure investment fee targeted specifically at electric and transport vehicles. Finally, the budget aggressively targets luxury and vice. Excise duties on alcohol and cigarettes have seen significant hikes, and the annual royalty to operate a modern casino has been pushed up to 50 million rupees. By placing premiums on capital flight, carbon emissions, and luxury vices, the government balances its ledger by penalizing the choices they want to discourage. Stepping back, the strategy of the 2083 budget becomes clear. Nepal has completed a transition from a system focused on income to a broad system centered on consumption. The cuts to direct taxes have a specific intent. Policymakers are incentivizing wealth generation, wanting citizens to work, build IT companies, and invest capital without a heavy income tax penalty. But the counterweight to that strategy is penalizing wealth consumption. Through these micro-taxes, the state extracts its revenue when you spend that money, while punishing capital flight and luxury imports. For your daily finances, the math translates into a specific psychological reality. The government has engineered a system that gives you a much heavier wallet on payday, but takes an invisible bite out of it every single time you open it.